Good morning, everybody, and welcome to KickStart Specialist Finance Webcast with myself, Nicola Firth from Knowledge Bank, and Joe Breeden from Crystal. So I'm going to kick us off this morning. I think Joe has some issues with video, but he is on the call, and we'll be speaking to everybody and do his bit when I've done mine. So let's get kicked off this morning with the updates that we had from last week. So criteria changes, there were 276 criteria changes last week, and that was a pretty quiet week, I've got to say. So it was down from 964 the previous week, so it was incredibly quiet, but there's some pretty significant stuff in there. So it was definitely a quality over quantity last week, I would say, and the back end of the week quite a bit busier. So the week, it was all about the LTVs again. So we saw the 95% come back in, and then they were withdrawn, but I'll go into a bit more detail on that because there is some good news on the higher LTV stuff still. So more and more mainstream lenders and smaller building societies are increasing their LTVs, albeit temporarily in some cases, but even that's a good thing. It is showing that they are wanting to lend and do what they can. So we've seen quite a bit of refining on affordability, especially for self-employed and furloughed workers. So that's quite significant. We've got some news on there too. And more specialist lenders were increasing their LTVs on certain ranges as well. So as we go through then, so Accord mortgages, now they introduced their 90% LTV products, as you know, and they had to withdraw quite quickly. They'd had their busiest day in 17 years. Oh, sorry, 2 seconds, bear with me. I'm just being told you can't see my screen. Just bear with me a second. Hold on. You've got to love technology, haven't you? While I'm doing that, I'll carry on telling you about Accord because that's pretty significant. So what happened with regards to to Accord? So they had they put their 90% products in, and they just got absolutely swamped. So they were left with no choice but to to pull them just because it was affecting service levels. However, what we did see last week was fantastic, and they've reintroduced some 90% loan to value products. So hopefully you can see my screen now, so that's good. So they introduced them exclusively for first time buyers. Now this is really, really good because even though we've got lack of 90% products, as we know, first time buyers are the ones that they shore the bottom of the market up. So the high loan to value stuff for them is essential in a lot of cases. So they have got them, that they're not on for a limited period of time. They put 90% loan to value first time buyer products, and to be eligible, at least one applicant must be a first time buyer, and their definition of a first time buyer is defined as having never owned a property or held a mortgage previously. So that's what they mean by that. So Bank of Ireland, they've announced that their valuers will carry out physical valuations in Northern Ireland. Now this is as long as it's safe for the valuer and the occupier. And if a physical valuation isn't possible, a desktop valuation will still be done up to 85% loan to value, so as not to delay the case. And desktop valuations still remain the only option in Wales and Scotland at the minute, but that will change shortly. So then moving on to Barclays. So Barclays are to stop accepting new buy-to-let purchase and remortgage applications for multi-unit properties, SPVs and limited liability partnerships. So this will include unencumbered applications, and with the last day for these submissions being the 26th of June. So just a date for your diary if you've got any of those kind of cases that you need to get into Barclays. The Coventry for intermediaries, so they have a 90% loan to value product transfer product. This is a 5-year fixed rate at 2.9% with no product fee on it, but it will have ERCs. And another one from Coventry that just to be aware of, they've updated their affordability calculator assessment and some of their lending policies, so they'll now accept 50% of overtime, shift allowance and commission, but not bonus payments. So it's just important to note that. So they'll accept those for affordability. Your client will need to show that they've received this income consistently over the last 3 months. So that could be a stumbling block if you think about the last 3 months for some clients, but as soon as they're able to, they'll take those things into consideration. They've also updated their essential expenditure data to reflect the most up-to-date view of living costs as well. So that's all in the background of the affordability calculator. So nationwide, they have reduced the LTV on their direct products to put them in line with broker offerings at 85% loan to value. So we're not fans of dual pricing, are we? So that's good from Nationwide. And Platform is reintroducing their Help to Buy mortgage alongside a range of 85% loan to value purchase products from this week. So TSB, they've made some temporary changes to their affordability assessment of furloughed workers. So this is quite a detailed one. So what you need to bear in mind that any cases that were submitted before Tuesday, the 16th of June, will be manually underwritten and assessed in line with this current criteria. So these are the changes then. So all applicants who've been furloughed must supply a letter from their employer confirming its intention to continue to offer them employment. The letter must be dated within 4 weeks of the full mortgage application and specify the date in which the applicant is due to return to work. It must also state whether the applicant will return as a full-time or a part-time employee. And the letter must also confirm the employer's financial responsibility under the government coronavirus job retention scheme to contribute towards the national insurance pension contributions and the applicant's salary if returning to work after the 31st of July. So coronavirus income impact form must be completed alongside the application, and salary entered must reflect the borrower's earnings at the point of submission. For any applicants who are employed but have not been furloughed, applications must reflect any salary cuts that have been made as a result of the COVID crisis. And TSB have also stopped accepting additional income from bonus, overtime, commission, anything like that that's not guaranteed towards their affordability assessment. So some quite big changes there, really. So moving on next, so Buckinghamshire Building Society, they've announced that they will now accept purchase and remortgage applications on their prime range, and this is including first-time buyers, 80% loan to value with a maximum loan of up to £1 million. And they've also increased their LTV on their buy-to-let range with a maximum of 70% loan to value and £750,000 loan. So Hodge now considering earned income up to the age of 80 for affordability, which is a really good increase. And the Monmouthshire Building Society, they've re-entered the market with a 90% loan to value product for both purchase and remortgage. So they've got 2 and 5 year fixed rate product options available. They have asked us to let people know to ensure that applications are fully packaged and that these products could be withdrawn at short notice depending on the popularity. So that, you know, they're very conscious of what the lenders have seen as well. And also bear in mind that physical valuations are still only available in England at the moment, and desktop are still restricted to in Wales. Newcastle intermediaries, in addition to their existing requirements, they're now requesting the last 3 months business bank statements from borrowers that clearly demonstrate current trading levels. So on a positive note, they said that they're happy to consider application where grants and support loans have been taken, but the principal requirement will still be the evidence around current trading levels. So that's pretty good from Newcastle to know that if companies have received any help from the government schemes, that they'll still be accepted. Now, Saffron Intermediaries, this is an interesting one. So they launched a range of 95% loan to value deals with no product fees, and that was on Tuesday of last week. And they were available for a limited time only, and they didn't specify when they were going to be withdrawn, but they did get withdrawn at 5 p.m. on Friday. So their maximum loan to value is 85%. We have seen some reports this morning that they might have still got one product left at 95% loan to value, but we can't correlate that with any of the information that we've got. So we're saying 85% loan to value is where we understand that to be at the moment. So Foundation Home Loans are increasing their maximum loan to value on the residential range to 80%. That's up from 75%. So again, an increased LTV, always welcome. Hope Capital, now they will now allow a range of valuation types. Having previously required a full valuation on residential properties, the bridging lender says in many circumstances, they're now able to lend based on AVMs, drive-bys or desktop valuations. So Keystone Property Finance, they've told us that if your client has a bounce back loan for any company with which they're associated, they will require the following information. So they're going to require, first of all, the reason for the loan, the amount of the loan, the date which the funds were received, and a bank statement showing that the funds were received. So any application where a bounce back loan is being taken will be reviewed on its own merit, so including the involvement of the bounce back loan in the business as well. Reliance Bank have reduced their maximum LTV for purchasers to 75% loan to value. United Trust, they've temporarily increased their minimum loan size to 125,000 across their bridging product range. And YBS commercial mortgages, they've announced that they've increased the maximum loan to value on their limited company buy-to-let facility to 75% with a maximum borrowing of £20 million for existing YBS commercial mortgage customers who've been with the society for at least 3 years. New customers can also take advantage of the 75% loan to value product up to a minimum borrowing limit of £5 million. So quite a lot of information there. We did say it being a relatively quiet week, but a lot of information. And as I say, it was definitely quality over quantity last week. So just to finish for my section, good news story. So a couple really. There have been calls for a cap on standard variable rates. So obviously we talk about mortgage prisoners specifically. The FCA are calling for an introduction of a cap on SVRs to stop mortgage prisoners being exploited or being forced to pay the higher rates. So there is an investigation going on into that at the minute, and the FCA have said that this should be happening quite quickly as well, because I think they are very conscious about the mortgage. They've done a lot of work around mortgage prisoners, and we've been involved in that as well with Knowledge Bank, so I do know that they're very conscious of that. And we've got two lenders that we've mentioned this week. They're going to be launched on Knowledge Bank with their full criteria being displayed on the system. That's Reliance Bank and YBS Commercial, and they'll be launched within the next few days, so watch this space. Just before I hand over to Joe, who I can actually see on a video now, which is fantastic. So just before I hand over, just to let you know that through Knowledge Bank, we have a specialist buy-to-let course running starting this week on the 25th. It's at 2 o'clock on the 25th of June, and it's an hour for 4 weeks. It's CPD accredited, and it's in association with Precise, presented by Roger Morris, who is absolutely fantastic. What he doesn't know about buy-to-lets isn't worth knowing. Talking about changes to taxation, legislation, absolutely everything, HMOs, the course covers everything. So it's a course of, so it's 4 weeks, an hour a week, and it is well worth signing up for that. So if anybody does want any information, we will send that out after we've done this presentation. So now I'm going to hand over to Joe, and it's good to see you, Joe. It really is.
Yeah, thank you. Honestly, technology, it's interesting, but here we are. Listen, I mean, again, whilst there might not be many changes, just what a volatile week again. I think this 95, 90, 85% LTV game is just it's just a bit of it messes with your mind really as a broker introducer. You know, you got surety with the client on one day, and if they haven't applied in time, then you miss out. So just a very, very volatile space and a lot of gamesmanship, as we talked about earlier. I think the other interesting point, well, in fact, two really that you raised there for me were, you know, this bounce back loans. We've talked about it for the last couple of 3 weeks, and to hear Keystone, you know, specify that, I think you'll find more and more lenders follow suit. There's a big piece of coverage in the Sunday Times yesterday around bounce back loans being used by property individuals as deposits. You know, we've talked about that again in a previous show, so I won't go over it in too much detail, but definitely, you know, source a deposit, make sure you're on it. From an advisory point of view, make sure that if it is borrowed, that the lender you're thinking of putting your customer with has full transparency around the source of that, because, you know, I absolutely think that this bounce back loan is going to be like Marmite. And officially, I don't think the government have said that they can't be used for further borrowing. So, you know, again, if your business is property investment and you have borrowed about, you know, you have managed to secure a bounce back loan against that company, I think there is a counter argument, to begin with. But absolutely, for, you know, the national media are on the case to seek assurance and guidance from the government. Rest assured, you know, they will be following up with a policy update in due course, will be my opinion. And I think the other massive point is Barclays. I mean, the fact that they've dropped out a limited company buy to let, the fact that, you know, they're not looking at multi-unit now, it just cascades down. You know, they're absolutely one of the biggest lenders in the market space, and for them to turn around and basically say that they only want sole proprietor or partnership buy-to-lets is a bit of a game changer. And if you're putting on a WebEx or webinar program for CPD with Roger Morris next week, you know, that's absolutely essential, because that man absolutely understands limited company and portfolio buy-to-lets like no one else. So well worth listening to him if you haven't already done so. From my point of view, I mean, we've just seen an absolute dirge of bridging and development finance over the last 2 weeks. Quite surprising, actually, how much of that sort of business we've actually taken on board. I think the big result for me last week was we managed to secure a £2.3 million net facility with alternative bridging. That was a re-bridge. The customer's term had expired during COVID, exit via sales. So sales interest had been slow on account of Brexit anyway, and then that rolled into COVID, and they're into all sort of default rates and penalties and things. And we managed to rehouse him, you know, for 2.3 million quid at quite a high LTV, which, you know, we're really proud of as a business, because not many bridges are out there that are looking at re-bridging, never mind at 2.3 and high LTV. So well done there to the guys at Alternative. In terms of payouts, I think a really a good example of a business standing on what was agreed pre-COVID was Foundation Home Loans for us. You know, we had an HMO deal which was at 75%, agreed and offered pre-COVID. They have audited the valuation and stood on that deal, which is at 2.89%. So well done the guys at Foundation. I think interestingly with that one, not only was it an HMO and they stood on the rate at 2.89 and were happy with the pre-COVID val and offer, they were still happy with the fact that the source of deposit was gifted from overseas as well. So, you know, many opportunities for a lender to kick out a deal, and they just didn't. They've stood on firm. So well done to the guys at Foundation. Very pleased to be working with you guys as one of your packager partners, which follows on nicely from the exclusive we got last week from you. And then lender of the week, again, continuing with the dev theme, I think Shawbrook Bank and particularly their development finance department have absolutely stood out there. Simon Knowles has joined them from Aldermore at the turn of the year and absolutely revolutionised that process. So if you haven't looked at those guys for development finance, please do. If you're struggling for any contacts within Shawbrook, please reach out to myself, because we've been partnering with them since day one, and their dev team, I'm absolutely confident, will be market leading in a very short space of time. So from my point of view, good to see you, and you know, let's have a good week. Hopefully the criteria changes have simmered down a bit, but I still kind of feel that we're going to get a bit more leveling out, you know, on this LTV piece, and that's about it for me, really.
Fantastic. That's quite a lot we've packed in there. So it was a relatively quiet week. It was some pretty key stuff, wasn't there? I think you're right about the LTVs. I think it's just I think as soon as some of the bigger lenders enter back into that space, it's going to make life a little bit easier, because the smaller lenders that they want to do it, they're just swamped,
inundated, aren't they?
Yeah, they are. But I think that was a great move from Accord last week, putting the 90% loan to value on for first-time buyers, because that was a really good move by them. It was fantastic to see, because they're, you know, first-time buyers are the ones that really need the high loans value stuff, and they're the ones that really shore up the market and get people moving, aren't they? So that'll be a massive help, and responsible from their perspective as well, that they can kind of control the amount of business they're going to get in if it's just first-time buyers and not everybody. So yeah, that was really good to see. Have we got any questions? Like, shall we have a little look, see if we've got any questions? We have a couple of people asked for details for the specialist buy-to-let course that we're running with Roger Morris and Precise. So we will absolutely send you those details out. Of course we will. We'll send those out after this webcast. But I don't know if anyone's got any more questions on anything we've discussed this week.
I think we got asked last week about updates to Help to Buy scheme extension. We still received no word on that yet. So we'll try and keep you updated weekly if we hear anything. But, you know, Accord doing what they've done there, hopefully that's a positive sign, because, you know, I echo your thoughts about that market space being where, you know, the area that needs the most support in order to get the economy and property market rocking and rolling again. Yeah,
definitely. A couple more people asking for the details for the buy-to-let webinar. Yes, of course. So, okay, we've got a question here. We've got a couple, actually. So Sunny's asking us, What's your feeling on a possible second wave? It's a difficult one.
God, I hope there isn't one. I hope there isn't one. That's my feeling. I hope there isn't one because, you know, ultimately, health comes before wealth. So absolutely, you know, I hope there isn't one. You know, my gut tells me that if we can survive the VE Day parades, the Dorset Beach congregations, and then the rioting without seeing a significant spike, we may be out of the worst of it. You know, I always try and be an optimist. I thought this was going to play out, you know, throughout the summer as it sort of has done. I think this week's a big week. I think we'll know more about the government and the chief medical and science officers' opinions this week. I think there's a big announcement coming on Tuesday with regards to getting the leisure and tourism industry back rocking and rolling, and what their plans are for getting all the kids back in school by September. So, you know, let's just follow the government lead, because they've got far bigger brains than myself. Potentially not Nick, but definitely myself.
No, it's me as well. Include me in on that. I think you're right. I think the thing that so I was thinking about this last week actually. I was thinking, you know, where are we as an industry? Because we don't know, we're not going to see a second wave and what that might look like. But the one thing that I feel a little bit reassured by is the fact that when you've already had an experience of something, you know exactly what you're doing next time round, don't you? So if they did put us in lockdown a second, we know what the score is. There's not, you know, and you know, there might even be toilet rolls next time. Who knows? It's ultimately, right. But with lenders, they've done the difficult bit now. They've put their processes in place. So actually, whether there's a second wave or whether this happens, something like this happens again with a different kind of virus, they've already got those things in place. So I do feel quite reassured by that, really.
I'd agree. I'd probably also add as well, I think personally the biggest threat to the economy now is probably job losses. You know, and you can see that, you know, with a lot of the lending criteria around furlough incomes. You know, I think you know, I've seen anything between 40% and redundancies from staff that are furloughed, you know, down to as little as 10. So it's just understanding how that played out. I mean, what we can see is the government has pumped a load of money into the economy. So hopefully, job cuts will be kept at a minimum.
Yeah, absolutely. One of the questions we've had from Tammy. So this might be one for you, Joe. It's a criteria question, but we might have to come back to you and have a little look on Knowledge Bank. So Tammy's looking for a lender who may consider 75% loan to value, joint borrower, sole proprietor, with one of the clients being over 65. Anyone?
Yeah, I think there's quite a few options for you there, really. I think it's just understanding what the asset is and a bit more about the deal there, really, Tammy. I think what we'll do is we'll drop you an email with a few options, and you know, you can go off and explore that afterwards. But I think you've got multiple options there. It's just a bit more about the security.
Yeah, definitely. And what we'll do as well, Tammy, is we'll drop you an email. I'm not sure if you use Knowledge Bank, but if not, what we'll do is we'll drop you an email so you can have a little look on there as well, because if you put those criteria in, joint borrower, sole proprietor, loan to value, maximum age, it'll tell you all the lenders that will do that, so you'll be able to have a little look. So yeah, sorry that we do have quite thousands of criteria. We've got over 100,000 pieces of criteria on Knowledge Bank that change. It's difficult to sort of keep up.
I think you'll be all right on that one. I think there's just quite too many for me to probably mention now, really, if I want to see this. So there's a bit more intricacies about the deal, so you'll be all right.
Brilliant. Anybody got any more questions before we wrap up for the morning? No, I think that's it.
Right, done.
That's it. Fantastic. Well, thank you everyone for your time. We will send details out to everybody on the Buy-to-Let course, and have a great weat. Enjoy the sunshine, because it's supposed to be a scorcher this week, isn't it? And we'll look forward to seeing you all next week.
Great. Have a great week, guys.
Thanks, everyone. Bye-bye.
Bye now.